Good afternoon. That was a little weak. Good afternoon. That's much better. I'm not sure what you're expecting. I heard Tom mention free beer. So I was just walking by. Well, liquidity is important in the mortgage industry. If somebody asks you why you're having that drink, tell them we know liquidity is very important. All right, so I thought we're backing up to happy hour here at some point. So I thought I would, to the extent that you're in a hurry, I'd give you 3 points to take away, and then I'll talk about them. First of all, interest rates go up and down. It's important to know that. They go both directions. And sometimes they go one direction for a while before they go the other direction, right? So you're in that business, you should expect that that will be true. The second thing is every human on the planet puts their head down on some kind of real estate every night, and that will always be true. What that means is this is a good business to be in. And the third thing is when somebody asks you, is it a good time to buy a house? Then the answer I've given for that's how many years it was, since I don't want to admit to that. I've given the same answer, which is at today's interest rates and prices, if in your family budget it fits, then today's a good day to buy a house. The key there is the family budget question. And it's Tom was talking about some things that you could do to help the clients that you have. One of them that you can do is talk to them about having a family budget, because they're going to get asked if they're going to borrow money. They're going to ask, where does the money come from and where does it go? So if they're prepared when they go talk to the lender with that information, that's what they're going to ask. So they immediately become a better customer because they're already educated on the kinds of things that that lender is going to care about. So those would be my 3 points. So now I'm going to see how many people leave the room. Oh, okay. All right. So at the beginning of this year, at the outset of every year, we spend a little time trying to think of a brief theme that will capture the dynamic of the succeeding year. And for obvious reasons, although rates were actually much lower at the beginning of the year than they are today, we anticipated that this would be a year in which there would be interest rate adjustments in the macroeconomy, and affordability would be the thing that everyone talked about. And that's turned out to be pretty much true. And each year we do that to kind of calibrate whether or not we were thinking about the right things at the outset of the year. So we feel pretty good about having characterized that. Oh, that just basically says Fannie Mae will deny I was ever here. I usually give them a reason to. So let's start with rates, since that was my first point. And the question on everyone's mind is, what does the Fed do about an employment report that came out this morning with twice the level of jobs added as was expected, and an upward revision from the last 2 months? So employment was much stronger this morning. And the Fed has been saying repeatedly that until they see some easing in the labor markets, they're likely to raise rates. So question whether or not today's release on the labor numbers suggests the Fed will raise again. Our forecast does not have any more Fed rate increases in it for this year or next year, but we also don't have declines until the end of the second half of next year. So, but if we're wrong, I would argue we are wrong in that the Fed is likely to raise one more time. Now, my first mortgage came from Sears Mortgage. I'm not that old. At one point, Sears, you could buy a house from Sears and they would ship it to your place and assemble it. I'm not sure if you knew that, but that's actually true. And Sears Mortgage was my first mortgage. at 8.5%. So we're sort of getting close to being back to that. One thing you should know is the average 30-year fixed rate mortgage from World War II out to the year 2000 was 6%. So while rates today are above 6%, they're not that far from the long-term average. So that's why I started by saying interest rates go up and down. What you should not have expected was to see 3% mortgages. And I would not make part of my financial plan that anytime soon you'll see another 3% mortgage. People ask, well, where do you think rates are likely to be? That's partly dependent on what you think the sustainable rate of growth that the U.S. economy can be, and then that has an impact on what interest rates will be. So the Office of Management and Budget produces an official estimate of how fast the U.S. economy can grow. The potential GDP is what they call it. And at the present, their thought is about 1.75% without inflation annually. What that would suggest to me is if you think about what interest rates look like in that environment, is that the mortgage rate, as housing typically has a cycle to it, an up period and a down period, it leads into recessions, it also leads out of recessions. Mortgage rates are likely over the longer term to range between 4.5% and 6%, maybe averaging 5.25%. We'll see. And the Fed's not done yet. They'll let us know when they're done. But I think that's not an unreasonable thing to think about, and it certainly relates to the long-term interest rates that we have seen. Now, policy can change and the economy can grow faster, or it can change and the economy can grow slower. Those things will impact what rates do too. But you can see here that the red line here is taking inflation out of the rates that the Fed sets. And what you see, they've only recently tightened rates net of inflation to where the real interest rates are positive. That suggests they may go further. So like I said, the risk to our forecast is to the upside in terms of the Fed increasing rates. Inflation measures, which they're raising rates to combat, for the last 3 to 6 months, have actually come down significantly, and most of the indicators are back around their 2% target. So it depends on whether they're going to look at short-term measures or longer-term measures of inflation. And Powell said in his last press conference, they're focused more on longer-term measures, so year-over-year measures, and those are still above their 2% target. All right, that just gives you a picture of that slowdown in inflation that I mentioned. This just basically says, look at that top orange bar, and that's being driven by the consumer. So the other thing that Powell said in his press conference is that where they underestimated economic growth, it was the strength of the consumer that surprised them. That's the same thing is true in our forecast. We had expected that consumers would be less resilient to the rise of interest rates, things like the renewal of the student loan payments that had been on forbearance, the slowdown in wage growth, which has happened. And the expenditure of the savings that they accumulated during the stimulus and all the transfers from the federal government to the household sector. But one question that's related to that transfer is the discussion of the rise in the size of the federal debt and the deficit, which is increasing that debt. Well, one of the things that happened in the course of the pandemic and the stimulus programs was that we shifted a lot of debt from private balance sheets to the public balance sheet. So I think I have some numbers in here that show, let's see if I can do this. there's the savings rate. So you can see the huge jump in transfers to households during the pandemic, and then you can see that they've spent that down so that it's the savings rate is now down under the longer-term average. Oops, let me back up. You have to be really careful. I grew up on a farm, and if you talk to my father, he would have told you that if it has more than 2 moving parts, don't call Doug. And this has 2 moving parts, so we'll see how this goes. He said more than, so I think we're okay. He meant that too, by the way. This is dividing households by the quintile of their incomes. And what you can see is the 2 lowest quintiles have essentially spent all of that saving, and they are now running up credit card balances. So going back to that comment I made about the household budget, that's going to be one of the reasons that you're going to want to help them be attentive to their household budget, because if they're running up debt in other areas, it's going to, at some point, impinge their ability to get mortgage financing. And you can also see on the light blue bar, which is the far right side of each of them, you can see that in every income category, savings are coming down. So that's one of the reasons there was an expectation that the consumer side might start to slow. But if you actually look at where they are, what you can see is if you look at the ratio of total debt service to income, while it's rising, in other words, the amount of payments relative to their income are coming up, it's still at very low levels because they paid down all this debt with the transfers. So while you read the headlines that say, well, there's rises in delinquency, that's true in credit cards, in auto loans, not so much in mortgages, in other household debt, the pace of delinquency is rising, but it's from very low levels. So at this point, we don't see a major problem. I'm just checking the time here because I know there's a Formula One race coming, and I want to see if I can qualify. So there's you can see the credit card balances there. Now there are some indicators that suggest that we are going to see a mild recession, which is actually our forecast for the first half of 2024, is that we will see a mild recession. What do I mean by mild recession? I mean 3 quarters over which economic growth will decline by about 0.5%. So pretty mild, and the reason it's mild is because of housing. Because housing is so tight that it typically is one of the leading things that take the economy into recession, but it's in a sense already there given the level of activity in the housing market. So it's not going to be the size of drag that would be typically the case in a recession. But it also leads the economy out of recession as interest rates fall and activity starts to pick up. So there are some indicators that suggest we're heading toward recession. One of them is corporate profits. When corporate profits fall, businesses start laying people off. When they lay people off, of course, the unemployment rate goes up. That's typically a sign that the slowdown in economic activity is underway. There's some problems in the banking sector you might have heard. My favorite statistic for the last year has been that $42 billion left Silicon Valley Bank in 6 hours. $42 billion of deposits were transferred in 6 hours. That's the power of technology, which has changed a lot of things. And I know you've been talking about technology in some of the other sessions today, and you'll undoubtedly talk about it some more tomorrow. But that has created some risk to some of our medium-sized banks who are pretty important because they're actually better at community lending than some of the larger banks are. I'll probably get some hate mail from that. Those banks, because of the deposit outflows that they have seen, have had to tighten credit in order to maintain margins and remain profitable. tightening of credit in the banking sector is usually a leading indicator of an economic downturn. In the employment metrics, one of the things that we look at is what's the willingness of people to quit their job? Because typically people don't quit their job unless they're confident that there's another one ready for them to move to. And the rate of quits has actually been falling, meaning that households' confidence in terms of being able to move to a better employment situation has backed off. That's part of what the Fed is looking for, is some slowdown in the labor department. That's just another measure of employment. I'm going to skip through some of these. They'll all be available to you. We're just trying to catch up a little bit because we're a little bit behind schedule. One of the things that I mentioned liquidity at the outset. And by the way, on that issue of beer, has anybody here ever seen any of the original copies of the Magna Carta? If you go to England, in Salisbury, England, there's a cathedral. In the back of that cathedral is one of the 4 remaining copies of the original Magna Carta. The thing that I loved when I read that, it's about this big. We think of it as maybe this huge document. It's about that big. One of the things that the nobles were petitioning the king for was honest weights and measures. And one of the commodities that they reference is beer. So the Brits had it right. Just saying. Another thing that points toward recession, not just the inverted yield curve, where short-term interest rates are higher than long-term interest rates. That's been in place for some time, and it has a very strong record in predicting recession. Another one is the index of leading economic indicators. It has been negative for 15 months, and that also has a very high correlation to recession. So that employment report that came out this morning suggests strength still. Some of these other indicators suggest that there are reasons to believe that the economy will slow down, and that is in our forecast. Though what I told the board of directors of Fannie Mae is I could give you a set of data that would make almost any argument. This is one of the most confusing times of forecasting that has occurred in my career, predominantly because the pandemic changed a whole bunch of behaviors which have not yet really stabilized. And so some things that in the past were closely correlated are not so closely correlated today because of behavioral changes, whether in households, in businesses, or in policy, that has changed some long-standing relationships. And we were talking before I came out here about rules of thumb or indexes. And I said one example that's central to what you do every day is, used to be the rule of thumb was a normal level of inventory in existing homes was 6 months. How many think it's still 6 months? You're probably more in how about 4 months? Think that's more normal? I'm not grading, and if I was, I'd grade on the curve, so you can raise your hand. How many months? 3 months. That's normal? Yeah, the point is, I think technology has changed the ability of people to shop. So people are buying, as you know better than me, people are buying houses online, never having actually been to them. And that changes the inventory dynamic. There's lots of other measures in the economy that have rules of thumb that have been altered by technology and some by the pandemic. And I'll talk about that a little bit more in the real estate stuff. So let me go to the real estate. I mentioned to you, this is our forecast, mild recession, first half of next year. Unemployment, I said 0.5% of economic growth decline, unemployment pushing 5%. If you went back 20 years and asked macroeconomists, what would you think about the economy with a 5% unemployment rate? They'd say, well, that's full employment. So it's another one of those rules of thumb. All right, so why is real estate a good place to be, other than that every human on the planet puts their head down on a piece of real estate every night? Demographics in the US are still very good. We're still 3 to 4 years away from the peak first-time home buying age of the millennial group, which is the largest population group that we have ever had. So the demand side of the equation is still out there. Right now, given our headline, awaiting improvement in affordability, some of them are able and are buying, so there is significant activity in home sales, probably around 5 million existing in new home sales this year, so there is significant business out there. It's just that it's significantly lower than it was a couple of years ago. Interest rates, after 40 years of declining or flat nominal interest rates, we are now, for the first time, in a rising rate environment, that first time that we've been in one for a long time. So a couple of things to understand about the structure of the mortgage market. So in this rising rate environment, the first time that mortgage rates passed 7%, the securitization market froze up temporarily. Now, why would that be the case? It would be the case because the investors who would buy a mortgage-backed security, which is backed by mortgages that have a 7% coupon, believe that when the Fed eases interest rates, the people with those 7% mortgages won't refinance. They don't think those securities will be there very long once the Fed starts lowering interest rates as inflation has ebbed to their targets. So what did you also almost immediately see? You almost immediately saw buy downs of interest rates. So the market responded within 2 weeks. The market assessed the problem, responded with a solution to keep consumers in the game with a recognition of what had taken place economically. So now rates have gone up again. Now they've passed, 7.5? I know some people are offering 8% rates. The same thing is true. The question is there a way to encourage investors to continue to buy mortgage-backed securities, which is the major funding mechanism for home purchases and refinances, with the knowledge that it's likely that when the Fed gets inflation back to where they are, that interest rates won't fall, and those mortgages will refinance, and those mortgage-backed securities will disappear. So you're seeing even more extended buy-downs for those who have had strong profit margins. The problem is at some point you're going to exhaust that. The builders in particular have been one of the earliest reactors because the share of total home sales that are comprised of new home sales is very high, historically high in the current environment, because here's a place where, after years of being ignored, the Gen Xers get a little airtime. They've been a little sore about it. We talked about the boomers aging in place, which they are doing exactly what they said they were going to do. They're aging in place, and they even got an assist from technology in the pandemic when the home health care technologically was developed. So I had a little skin issue. It started before the pandemic. I was supposed to go in after the pandemic. I called the doctor. She said, well, we're not taking patients, but if you have an iPad, just I'll give you the connection. We'll connect up on an iPad. You can show me what it looks like, and we'll do it that way. Well, that only extends the time that boomers can, not that I'm a boomer. I saw where you were going with that. A little attitude coming up to happy hour here. But it allows them to stay in their home longer because they can get those services that enable them to stay there longer. The Gen Xers are the people that locked in 3% mortgages. So, and I had been making some comments, so I tested with some people that I knew were Gen Xers. Some of you are going to, if you are a Gen Xer that owns a house, there's a good chance you'll become an investor at some point. The reason is the mortgage payment at 3% is probably $1,000 under what the rent is in that market. And so you're likely to rent that out. If you have to move for some reason or want to move, you may well decide to rent that out and take that $1,000 to subsidize the higher mortgage payment that you would have to take or to pay on the house that you would buy wherever you move to. So not all those 3% mortgages are going to run off anytime soon, simply because there are other strategies that households can play to keep those. On the other hand, some people will be willing to give them up if they're living, say, in a high-cost, high-value market, and they're moving to a lower-cost, lower-value. The equity that they can take out of that higher value may be more than enough to allow them to buy with cash in a lower-cost market. That certainly, we are seeing some of that as well. So there's a bunch of strategies that work around high interest rates. I heard Tom talking about high interest rates. That's why I started with the interest rates go up and down. There are other strategies to work around just the interest expense component. One of the things that's getting a lot of attention is this widespread. Typically, the mortgage interest rates are closer to the 10-year Treasury rate than they are today. Well, there's a number of reasons for that. The Federal Reserve is still the single biggest holder of mortgage-backed securities in the world. The only group that's bigger than them are depository institutions. The Fed holds about 21% of all the MBS. Banks and credit unions together own about 29% as a group. But the Fed no longer wants to hold them, so they are not buying. They are actually letting them run off. So there's two questions there. If the Fed's not buying, who's going to buy? And at what yield? And the second one is, will the Fed, the people that replace the Fed, are there enough of them when there's also this huge growth in the issuance of U.S. Treasuries to keep that margin narrow? There's a bunch of other things, like if prepayment expectations are that they will prepay early, the investors will want a wider spread. So there's a number of factors, but we don't expect that spread to come down anytime soon. That's more information on the Fed's balance sheet. So here's, this might be my next favorite chart. I'll show you my current favorite chart shortly. This might be my next favorite chart. But this one, and we are before happy hour, so it's okay to show it here. What this is the relationship between federal budget deficits and unemployment. So typically, when unemployment goes up, federal deficits go up because tax receipts fall, because people have lost their jobs, and business profits have fallen, so tax receipts have fallen. In addition to which, some of what economists call automatic stabilizers, things like unemployment insurance, those kinds of things kick in, and they are funded on a deficit basis. So what you see is, for a long time, those two things worked in strong correlation one to another. So if unemployment went down, so did budget deficits. If unemployment went up, so did budget deficits. What you see in the period from 2015 all the way out to today is a dramatic shift in that relationship, suggesting we are running much larger deficits than would normally have been the case with the level of unemployment that we have. So probably the biggest question today, with the recent run-up in interest rates, is that run-up in interest rates being driven by expected much stronger economic growth, or is it being driven by the fact that bond investors are going to require a lot more yield because of the massive size of deficits that we are running? Those are two very different interpretations, and they have very different solutions from a policy perspective. So I would say that's probably the debate that's underway at the Fed, because as I said, those near-term inflation measures are pretty close to being back to their 2% target. But we have these huge this huge deficit, and it's adding to debt such that the current outstanding federal debt is the largest, including World War II, when we were fighting a global war. That's going to underpin a lot of discussions about where interest rates are going to go. Oh, that's where we are today compared to World War II. Excuse me. All right, I have some water here. Excuse me. See if I can, yeah, not a beer. Nobody did bring me a beer. I thought maybe if I started with that, a Pilsner Urquell, maybe, a Grolsch, Coors Light. All right, thank you. The supply issue is the primary driver for why house prices have not come down. So when we saw in July of last year the dramatic upturn in rates, for about 1 quarter we actually saw a national decline in house price. Then the next quarter it was flat, and since then prices have been rising again, which goes back to that demographic picture that I showed you and the very low level of supply that we talked about in our informal survey. That's likely to remain in place for some time, so I would not expect, as Tom said, that house prices are going to fall nationally at any time soon. There will be some markets in which prices will come down. We've seen, actually I think I have some charts here of the migration of, or maybe I don't. I failed. I have 2 charts of the U.S. that show the migration, show the level of house price change and the direction of population migration to the east, Midwest, and Southeast, away from the West Coast, which are the higher cost markets, and some of those are seeing house prices come down. I skipped over one other chart there that I want to mention. I can go back to it. I think. Come on, you can do this. This chart. And that basically says that 90% of outstanding mortgages are more than 300 basis points or 3 percentage points lower than current market rates. And I think we did this when the market rate was about 6 3/4. So it's probably 95% of all outstanding mortgages that are more than 3 full percentage points below current market rates. That suggests it'll be a long time before those things get worked off. Because let's suppose our forecast of recession turns out to be true, I would not expect interest rates to go anywhere near, mortgage rates to go anywhere near 3%. They may come down to 4.5%, so that's why I told you earlier, somewhere in the range 4.5% to 6%. They may come down to 4.5%, so some of those loans will come into the money, but the vast majority of them will not come into the money. Because from a refinance perspective, you need at least another 50 basis points below the existing note rate to get there. I don't see that happening anytime soon. So some of those people that take 7% mortgages, when rates come down, they'll refinance, but there's not going to be many of them. So I told them I'd try to catch up a half an hour, so let me go to the forecast. So you can actually, I can give you some numbers. Like I spoke to a group of 1,500 accountants. It was a AICPA bank accounting conference. And I told them, I said, you know, economists are pretty good, people that are pretty good with numbers, but they don't have the personality to be accountants. It was silent. So I said, I'm never sure who gets insulted by that. Then they laughed. So, as you can see, this is basically you did 2 years worth of business between June of 2020 and June of 2022. You did 4 years of business because of where rates were. Because people were moving out of fear of the pandemic, so they were making a move earlier than they would have made had the pandemic not occurred, and they were taking advantage of 3% interest rates. So you had 4 years of business that was done in 2 years. This is 2 years of payback. That's basically, so it's not like no business is being done. Like I said, probably 5 million home sales, but that's down from 7 or 7.5 million. So it feels rough, and it is if you didn't make some plan for how you're gonna distribute the profits that you made during that time period over this period when activity will be lower. So in this forecast, if you look at it carefully, you'll see we expect that things will start to pick up again in the second half of 2024. That will be kind of the end of that 2 years of give back. So that's kind of the simple way of thinking about it. It's not like there's no transactions, just that it's a lower level because of the move forward that some households took during that time frame. And we put out a blog on that. You can, by the way, go to our website, and there's lots of information we put up there free. There's no paywall or anything. One of them was we did a blog where we did a survey of people to find out, did they do that? Were they making that move? Was it just about interest rates? And the answer was actually more people were making the move because of overall family considerations than just the mortgage rate. So let me finish there. Any other topics that I didn't cover that you really want me to cover? I'm willing to take, I'm from Washington, so if you ask me a question I don't like, I'll answer a different one. That's what they do on all the talk shows. It's only fair. All right, well, I'll be around, so look forward to meeting you and answering any questions that you have. And thanks for your patience.